All right, so the really great thing about when you get through Mass Bay, you pass this accounting course, you get a great job because you know so much, and they know that community college students know what they're doing. You can buy some stock. And the really cool thing about owning stock is that a lot of the stocks pay dividends. And so you personally could be getting a dividend check, every quarter, just to add to your savings, okay? So dividends, I'm going to talk about cash dividends, we'll talk about stock dividends. There's also property dividends, but we don't talk about that. What is a dividend? It's really a distribution to the owners. When you buy common stock in a company, you are an owner of the company. And so the stockholders are the owners of the company. So a dividend is just paying out a payment to the various owners of the company. So if you own 100 shares of stock, you'd get so much per share. If you owned 1,000 shares of stock, you'd get so much per share. So usually the dividends are going to be in cash, and that's what we'll look at here. The next video we'll look at your stock dividends. Okay, so let's see. Before a company can pay a dividend, there's got to be a couple of conditions met. There has to be enough retained earnings to cover the dividend. Then it's also good if the company has enough cash to pay the dividend. In order to do a dividend, the board of directors of the corporation has to declare the dividend. So the first date you have to know is the declaration date of the dividend. That is the date that the dividend becomes payable or distributable if it's a stock dividend. So that's the declaration date. The date of record is the date that people who own the stock on that date will receive the dividend, and people who don't own the stock on that date won't. That sounds kind of straightforward, but if you think of all of the millions of shares of stock that a corporation might have outstanding, people don't just buy it and then keep it. They're always trading it on the stock market. So in order to pay a dividend, they've got to have a legitimate list of, okay, who owned the stock on that declaration date, so we're not paying people who didn't own the stock. So it's not as simple as it sounds. Okay, so that's the declaration date, and then the payment date is fairly self-explanatory. That's the date we send out the checks. So what do the journal entries look like on these dates? When the declaration date, at this point you would be debiting cash dividends, but we're not paying them yet, okay? And at this point we have a dividends payable. Okay, the date of record, that is simply the date that everybody who owns the stock on that date will get it. And so that you don't really do a journal entry, but you could just do a memo that it was the date of record, okay? And then on the payment date, that's when we debit our dividends payable and send out the dividend checks. Okay, so I think I do an example here a little further down in the notes. This company has 80,000 shares of common stock. They declare $1 per share cash dividend on November 1st. So on November 1st, 80,000 times $1 per share. We now have a dividend payable of $80,000. Okay. We would simply do if the date of record is 12/1, we might do a memo, that's just the date of record. And then we have a 12/31 payment date. And at that point, you'd simply debit the dividends payable and send out all the checks in cash. Okay, so that's basically your cash dividends. There's not too much that's going to mess you up with that. And so I think we'll just move on to stock dividends.